You have $1,000 to invest. Where do you invest? MetroCoffee or Daily Brew? Both have a PEGI ratio of around 1, but MetroCoffee pays a 10% dividend. That's $100 a year in your pocket. Daily Brew pays you nothing. Easy choice, right? MetroCoffee. Wrong. The company paying you $100 a year is the one that is going to cost you everything. And the company paying you nothing, that's the one that's actually making you money. Sounds backwards, I know, but by the end of this video, you'll see why, using one number most investors ignore, free cash flow. In the last video, I showed you MetroCoffee pays out 150% of earnings, but that's accounting profit. Free cash flow is actual cash in the bank. And when you check MetroCoffee's free cash flow, that 150% isn't just bad, it's so much worse. Hi, I am Nick, the guy with a Greek accent and a long-time value investor. By the end of this video, you'll know exactly where this dividend money is coming from and how to spot this trap in any stock before you lose a dime. So, what's the difference between free cash flow and earnings? Let me show you with a real example. You open a coffee shop named Kalimera on the Greek island of Nisyros. You hire one employee and you pay her $30,000 a year. That goes straight into your expenses, no questions asked. At the end of the year, your accountant sits you down and says, after everything, rent, wages, coffee beans, you made $50,000. You are thrilled. You are already Googling real estate in Santorini to expand your business. But then you start doing the math yourself. Remember that big hotel down the road? You sent them $6,000 worth of coffee in November. They said they will pay in January. Your accountant already counted it as revenue, but that money is not in your account, not yet. And the equipment? Your espresso machine died in December, $8,000 gone. The refrigeration unit gave out in September, another $6,000. You signed both checks. $40,000 walked out the door. Your accountant says, relax, I'm spreading both over 10 years, so I only counted $1,400 this year. That's called depreciation. Instead of counting the full cost of the machines up front, accounting rules let you spread it gradually over their useful life. And technically, he is right. That's how the rules work. But you didn't pay $1,400. You paid $40,000. So free cash flow looks at what actually happened in your bank account. You start with that $50,000. You add back the $1,400 depreciation because that was never real cash leaving your account. Your accountant just subtracted it on paper. Then you subtract the $14,000 you actually paid for the machines. And you subtract the $6,000 the hotel still owes you. What is left? $31,400. That's your free cash flow. That $31,400 is the money you actually have left to do whatever you want with. Pay yourself, pay down debt, save for next year or expand, because it is the cash that truly landed in your pocket, not just a number your accountant wrote down. Same business, same year. 31,000, not 50. Your accountant isn't wrong. He is using accrual accounting, the standard method where revenue counts when it is earned, not when it is paid. Free cash flow ignores all that and asks one brutal question. What actually landed in your account? Now let's take the lesson from Kalimera and scale it up to MetroCoffee. Thousands of locations. What does their bank account actually look like? To find out, we turn to the cash flow statement, one of the three financial statements every public company is required by law to show you. The cash flow statement has two lines that matter for us today. The first one is cash from operating activities, $180 million. This is not revenue. This is what is left in the bank after the business paid all its bills to keep running this year. Now the next line. Payments for acquisition of property, plant and equipment. This line is also often called capital expenditures. This is not your day-to-day spending, the rent, the coffee beans, the supplies. It is the physical assets the business had to buy or replace just to keep existing. Every espresso machine that died across all 3,000 locations this year, every refrigeration unit that gave out, new store locations, building renovations, equipment replacements. If MetroCoffee didn't spend this money, locations would start closing. This is the bare minimum cost of staying alive as a business. $150 million gone. So we do the math. Free cash flow is cash from operations minus payments for acquisition of property, plant, and equipment. $180 million minus $150 million. That is $30 million. That is the cash left over after the business took care of itself. Now we need to bring that down to per share so we can compare it to the $1.5 dividend. MetroCoffee has 100 million shares outstanding, so you divide $30 million by 100 million shares and you get 30 cents. 30 cents per share. That is the only number that actually matters here. If you owned MetroCoffee in real life, you would lose most of your investment. Do you remember Daily Brew, the company from the beginning of this video? The one paying zero dividend. Daily Brew's free cash flow per share is $1.80. They are generating more real cash per share than MetroCoffee's entire dividend. The company that is paying you nothing is swimming in cash. The company paying you $1.50 has 30 cents. The dividend you don't get is the growth you get. That is the paradox of yield chasing. So MetroCoffee generates 30 cents per share but pays out $1.50. Something is way off. But before I tell you where that extra $1.2 is coming from, I want you to understand just how bad 30 cents actually is. Because you might be thinking, okay Nick, it is not great, but at least it is not zero. Let me introduce you to Kodak. Eastman Kodak, once one of the most dominant companies in the world, filed for bankruptcy in 2012. In 1999, Kodak was generating $750 million in free cash flow. The dividend was $1.76 per share. Everything looked fine. But digital cameras were exploding. Film was dying. And Kodak had over 100 facilities, plant, chemical lines, coating machines, all requiring constant cash just to keep running. The free cash flow started bleeding, and Kodak kept paying the dividend the whole time, until they couldn't anymore. So they cut it, and they cut it again. Then free cash flow didn't just decline, it went negative. There were brief recoveries, asset sales, tax settlements. But it wasn't a turnaround. It was a company selling pieces of itself to stay alive. 2009, dividend suspended. 2012, bankruptcy. Kodak in 1999 had $750 million in free cash flow and still went bankrupt 13 years later. MetroCoffee has 30 cents per share and a $1.5 dividend. You see where this is going, don't you? So where is that extra $1.2 coming from? There are only three places, only three. Companies funding dividends are doing one of three things: borrowing money, selling assets, or draining cash reserves. None of these last forever. There is a borrowing limit, a finite number of assets, and a bottom to any cash reserve. When that bottom hits, the dividend gets cut, the stock craters, and that 10% yield just cost you 40%. So how do you spot the trap before it closes? Imagine two investors, Mary and John. Both find MetroCoffee. Both see the 10% yield. But one of them runs this test first. Step 1. The free cash flow payout ratio. Mary doesn't look at the payout ratio on the front page of the finance site. She goes straight to the cash flow statement, takes the total dividends paid, divides by free cash flow. MetroCoffee comes back at 500%. 500. For every dollar of real cash the business generates, They are promising investors 5. She already knows something is wrong, but she keeps going. Step number 2. The 5-year trend. One bad year isn't a death sentence. Maybe they built a new factory. Maybe it was a rough quarter. She pulls out the last 5 years of free cash flow and lays them side by side. And what she sees look exactly like Kodak. Not a dip, a slow, steady bleed. The business is shrinking. The dividend is not. The trap is being set in slow motion. Step number 3. The debt tiebreaker. Now she checks the balance sheet. Long-term debt. Is it flat or is it climbing? MetroCoffee's debt has gone up every single year for 4 years, while the dividend stayed the same. That is her answer. They are not paying her from profits. They are taking out a loan, handling her the cash, and calling it a return. She closes the tab, puts her $1,000 somewhere else. John, he bought MetroCoffee for the yield. 5 years later, he is still waiting for it to turn around. We know MetroCoffee is borrowing to pay that dividend, but borrowing isn't free. Every dollar they take on comes with an interest bill attached. At some point, that interest bill starts competing with your dividend for the same shrinking pool of cash. That number has a name, the interest coverage ratio, and that number tells you exactly how much runway they have left. That's the next video. Click here to watch it. I'll see you there.